In this session, I'm going to take you through the complete accounting cycle for a small business, from initial transactions all the way through to financial statements and tax. This is not just theory. We will go step by step through a full example, and by the end, you should be able to record transactions using double entry, apply adjustments like depreciation, accruals, and prepayments, prepare an income statement and a balance sheet, and calculate taxable profit. The principles I'll explain apply globally because financial reporting follows the same logic. So by the end, you won't just understand accounting, you'll be able to apply it. Before we start working with numbers, you need a clear structure in your mind. Accounting is not just about recording transactions, it's about presenting a true and fair view of a business. Every transaction affects one or more of these 5 elements: assets, liabilities, equity, revenue, and expenses. At its simplest, accounting answers 3 key questions. What does the business own? It owns assets. What does the business owe? It owes liabilities. What belongs to the owner? Equity belongs to the owner. Assets and liabilities are also classified by time. Assets are divided into current and non-current assets. Current assets like cash, inventory, and receivables are expected to be used or converted into cash within 12 months. Non-current assets like plant, property, and equipment are long-term resources used in the business. Liabilities are divided into current and non-current liabilities as well. Current liabilities like payables and short-term loans are obligations due within 12 months. Non-current liabilities like long-term debts are long-term obligations. All of this is held together by one fundamental rule: assets equals liabilities plus equity. This equation must always balance. Everything the business owns has to be funded by either borrowing money, called liabilities, or the owner's investment, called equity. As the business operates, revenue increases equity and expenses decrease equity. So even though we track 5 elements, they all connect back to this equation. Let's assume we are preparing accounts for a small coffee shop for 1 month. The owner invested £10,000 into the business. This is the initial cash put in to start the coffee shop, for example, to fund setup and day-to-day operations. Equipment was purchased for £3,000. This could include items like a coffee machine, grinder, fridge, and basic furniture needed to run the shop. Inventory was purchased for £2,000. This would be things like coffee beans, milk, syrups, pastries, and other items that will be sold to customers. Sales of £6,000 were made in cash. This represents revenue from selling coffee and food. £1,000 was on credit, for example, catering for a local office that will pay later. Rent of £800 was paid. This is the monthly rent for the coffee shop premises. Wages of £1,500 were paid. This covers salaries for baristas or part-time staff working in the shop. Advertising of £400 was paid, for example, social media ads, flyers, or a local promotion to attract customers. Insurance of £1,200 was paid. This covers 12 months, for example, business insurance for the premises and equipment. Electricity expense of £300 was incurred but not yet paid. This relates to energy used during the month, but the bill will be paid later. A customer paid £500 in advance, for example, a company prepaying for a future event or regular coffee supply. A loan of £2,000 was received. This could be a small bank loan or funding to support the business with additional cash. Now, before we go any further, we need to understand one key idea that sits behind everything in accounting. Every transaction has 2 sides: what the business receives and where it comes from. The owner invests £10,000 into the business. Now stop and think. What did the business receive? It received cash. So cash, which is an asset, increases. But here's the important part. Where did that cash come from? It came from the owner. So the owner's interest in the business is equity. It also increases. So 1 transaction, but 2 effects. Cash goes up and equity goes up. In accounting, we record this using double entry. Don't worry about memorizing rules, just focus on the logic. We show this using two accounts. Because cash increased, we record 10,000 on the left side, called debit. On the right side, called credit. Because equity increased, we record 10,000 on the right side. And here's the only rule you need to remember for now. Assets increase on the debit side. Equity increases on the credit side. Every single transaction follows this same logic. Let's move to the next transaction. We purchase equipment for £3,000. What did the business receive? It received equipment, things like coffee machines, furniture, fridge. So the business now owns fixed assets. That means assets increase. Now the second question, where did the money come from? In this case, we paid cash. So cash goes down. One transaction, two effects. Equipment increases, cash decreases. And this is a really important point. This is not an expense. Now let's record it. On the left side, we record the equipment. Because it increased, we put £3,000 on the debit side. Then we look at cash. Cash has decreased, so we record £3,000 on the credit side. Now, let's go one step further. There's the question. Did we use all of that equipment in one day? No, we're going to use it over several years. So if we recorded the full £3,000 as an expense today, our profit would look far too low and next periods would look too high. That wouldn't reflect reality. So instead, accounting does something very important. We spread the cost over time. This is called depreciation. Let's say the equipment lasts 3 years. That means £1,000 per year, about £83 per month. It means this month we used part of the equipment. Now let's record it. First, we recognise an expense because we used part of the asset. So we record depreciation expense on the debit side. Second, the value of the equipment reduces, so asset value decreases. We post it to accumulated depreciation on credit side in the balance sheet. And this is a key idea. Depreciation is not about cash, it's about reflecting usage and true profit. Now let's connect this to something bigger. All the expenses like rent, wages, electricity and depreciation go into one place. That place is the profit and loss account. So when we record depreciation, it reduces profit because it reflects that we used part of our assets to generate income. Now let's look at the other side. Not performance, but position. The balance sheet shows £3,000 minus depreciation £83 equals £2,917. So the balance sheet shows the remaining value of the asset. Now you can see the full picture. Depreciation affects both statements. It reduces profit in the P&L and it reduces asset value in the balance sheet, and this is the power of accounting. Our next transaction is inventory. In the coffee shop, inventory includes things like coffee beans, milk, sugar, syrups, tea bags, and so on. These are items coffee shop buys to sell or use in making sales. At the moment, shop buys inventory. It still owns it. It hasn't sold it yet. Inventory still has value. So it is an asset. Inventory increases, debit £2,000. Cash decreases, credit £2,000. Inventory only becomes an expense when it's used or sold. So when we make sale, we don't expense the full £2,000. We only expense the portion that was actually used to generate revenue. This is called cost of sales. Let's say out of the £2,000 inventory, £1,200 was used to make coffee this month. Then £1,200 becomes an expense, called cost of sales. £800 remains as inventory, which is an asset. When inventory is used, we debit expense and credit inventory as inventory decreases. Inventory moves from the balance sheet into the profit and loss. In the profit and loss, we show cost of sales. This reduces profit. In the balance sheet, we show remaining inventory as a current asset. Now let's move to the part of the business that everyone focuses on, sales. In our example, the coffee shop has made £6,000 in cash sales. When we make a sale, two things happen at the same time. First of all, the business receives cash, so immediately we know that cash, which is an asset, increases. It came from the business actually trading, from serving customers, from selling coffee. The business has now earned income. In accounting, we call that revenue. The business has more cash, and at the same time, it has generated revenue. This is why we record two entries: the increase in cash on the debit side and the increase in revenue on the credit side. Revenue is simply what we earn from customers. Profit is what remains after we take away all the costs of running the business. So from this 6,000, we still need to consider things like the cost of the coffee beans and milk we used, the rent we paid, the wages, the advertising, and all the other expenses. Only after all of that do we arrive at the real profit. So sales are important. They bring money into the business, but on their own, they don't tell us how successful the business actually is. In terms of our financial statements, this £6,000 will appear in the profit and loss account as revenue because it reflects the performance of the business. At the same time, the cash we received will appear in the balance sheet because it shows what the business now owns. A single transaction increases cash on the balance sheet and increases revenue in the profit and loss account. Now let's look at the transaction sales on credit of £1,000. This means the business has made a sale but has not yet received the cash. Instead, the customer will pay at a later date. So, we are effectively giving the customer short-term credit. There are two key elements here: revenue, the business has earned income, and trade receivable, which is debtor, the business is owed money. Using double entry principles, we debit trade receivable because this is an asset increasing, and credit sales revenue because income is increasing. Let's break down what this does to the financial statements. Statement of profit or loss. Revenue increases by £1,000. This increases profit. Statement of financial position. Trade receivables increases by £1,000. There is no immediate impact on cash. Revenue is recognised when earned, not when cash is received. This is part of the accruals concept, which is fundamental in financial reporting. Even though no cash has come in, we still record the sale because the goods or services have been delivered and the earning process is complete. Now let's move on to the transaction, rent paid of £800. The business has paid cash for rent, which is a cost of using premises for the business, for example, the coffee shop space. Let's apply double entry. We debit rent expense because expenses increase, and credit cash account or bank because cash is decreasing. Rent is an expense, so it reduces profit by £800 in the profit or loss account. Cash is an asset. It decreases by £800 in the statement of financial position. This follows the matching accruals concept. Expenses should be recognised when they are incurred in the same accounting period as the revenue they help generate. Now let's look at the transaction. Wages paid of £1,500. The business has paid employees for their work, for example, baristas working in the coffee shop. This is a cost of running the business. Let's apply double entry. We debit wages expense because expenses increase, and credit cash account or bank because cash is decreasing. Wages are an expense, so they reduce profit by £1,500 in the profit or loss. Cash is an asset. It decreases by £1,500 in the statement of financial position. Wages are recognised as an expense when the employees have worked, not necessarily when they are paid. This again follows the accruals concept. Expenses are recognised in the period in which they are incurred. Now let's look at the next transaction, advertising paid of £400. The business has paid for advertising, such as social media ads or promotional materials, to help attract customers. Let's apply double entry. We debit advertising expense because expenses increase, and credit cash account because cash is decreasing. Advertising is an expense, so it reduces profit by £400 in the statement of profit or loss. Cash is an asset. It decreases by £400 in the statement of financial position. Now let's look at the insurance payment of £1,200. This payment covers 12 months, from January to December, which is our full financial year. Under accounting principles, particularly the accruals concept, we don't treat the whole £1,200 as an expense in January, even though we've paid it. Instead, we spread the cost over the period it relates to. So, £1,200 divided by 12 months gives us £100 per month. This means, for January, we only recognise £100 as an expense. The remaining £1,100 is a prepayment because it relates to future months from February to December. Accounting treatment for January at the time of payment. Debit prepayment £1,200 and credit cash £1,200. At the end of January, we debit insurance expense £100 and credit prepayment £100. What we're doing here is matching 1 month of insurance cost to 1 month of business activity. The rest hasn't been used yet, so it remains an asset. This is why prepayments appear in the statement of financial position, not the profit or loss. So for January, even though we paid £1,200, the real expense is just £100. The rest is still sitting as a benefit for future months. Now let's move on to electricity expense of £300, but this time it has not been paid yet and invoice not received. This is the opposite situation to insurance. With insurance, we paid in advance. Here, we've used the electricity, but we haven't paid for it yet. Under the accruals concept, we must recognise expenses when they are incurred, not when cash is paid. So even though no cash has gone out and invoice not received, the business has already consumed electricity in January. That means we must record it as an expense for January. We debit electricity expense £300 and credit accrued expenses £300. An accrual represents an expense that has been incurred but not yet paid. It is recognised as a liability in the statement of financial position because the business owes this amount. So unlike prepayments, which are assets, accruals are liabilities. Now let's look at customer payments of £500 received in advance. Here, the business has received cash from a customer, but it has not yet provided the goods or services. Under accounting principles, especially the accruals concept and revenue recognition principle, we cannot recognise this as revenue yet. Revenue is only recognised when it is earned, not when cash is received. Even though we have the £500 in cash, we actually owe the customer a service or product. So this creates a liability known as deferred revenue or revenue received in advance. When cash is received, we credit deferred revenue £500 and debit cash. This £500 represents an obligation. The business must either deliver goods or services in the future or refund the customer. So instead of recognising revenue, we recognise a liability in the statement of financial position. Now let's look at a loan received of £2,000. In this case, the business has received cash, but unlike customer income, this is not revenue because the business has an obligation to repay this amount in the future. Under accounting principles, a loan is classified as a liability. When the loan is received, we debit cash £2,000 and credit loan payable. So loans go to the statement of financial position. Now that we've recorded and understood all the transactions, the next step in the accounting process is to prepare the trial balance. The trial balance is simply a list of all ledger accounts and their balances at the end of the period, in our case, at the end of January. Its main purpose is to check that total debits equal total credits, which helps confirm that our double-entry bookkeeping is arithmetically correct. Now we summarise all those balances into the trial balance. Cash, equipment, accumulated depreciation, inventory and prepayment are assets. Loan, accruals and deferred revenue are liabilities. Capital is equity. Revenue and expenses are profit or loss statement. It's called income statement. Once the trial balance is complete, we use it to prepare the two key financial statements. Profit or loss statement shows the performance of the business for January. We take revenue minus cost of sales, expenses which are rent, wages, advertising, insurance for January, electricity, and depreciation. This gives us the profit or loss for the period. Statement of financial position, or balance sheet, shows the financial position at the end of January. We include assets, which are cash, equipment, accumulated depreciation, inventory, and prepayment. Liabilities, which are loan, accruals, and deferred revenue. And equity, which is owner's capital plus profit. This is the full accounting cycle: transactions, ledger, trial balance, and financial statements. And everything is based on the double entry system and the accruals concept. So once you understand the logic behind each transaction, preparing the trial balance and financial statements becomes a structured and logical process, not just memorization.